Hey there, welcome back to the Martino Minute podcast. I'm Selena Martino, and joining me again is Steve Martino, founder of Martino West Business and Insurance Solutions. And today we're diving into something I think a lot of business owners are starting to feel, whether they fully understand it yet or not. And that is the workers' comp market starting to shift again. Steve, you've been in this space for a long time. What are you seeing right now?
Yeah, it's funny that we've been in what's called a soft market, meaning rates have been dropping or been competitive in the work comp. We're talking work comp from maybe 2015 to 2025, like 10 years. That's unheard of in the work comp market. Normally, it goes up and down in a much shorter period of time. And so, what all the indicators are is that from 2015 to 2025, the work comp combined ratio, meaning how much premium the carriers took in and how much they paid out in claims, has been running between 86 and 91%. That's called a combined ratio. That means that they made money, between 14 and 9% on the premium just in underwriting losses, meaning I take in $100 for premium and I paid out $95 for claims. And what happens is the carriers, they take your premium. It's kind of like, I don't want to show disrespect for insurance carriers, but it's a financial transaction. If they can take $100 of premium in and pay out $100 in losses, they still make money because they take that premium and they invest it in AAA rated bonds and things. So they make money on the money you give them. And so if they can go to 1-to-1, meaning a combined ratio of 100%, they're still making maybe 3 to 5%. If they have a combined ratio of 90%, then they're making that 3 to 5% on the investment income, and they're making another 10% on underwriting profit. So when I say combined ratio, it's just a factor of whether they're paying out more than they're taking in. What's going on, especially California, because California is anywhere from 12 to 24 months ahead of time for the rest of the country. The combined ratio in California for, I think, 2025 was 127%. So they paid out 27% more than they collected in premium in just that 1 year. And that's the beginning of what's called a hard market. And so we're headed, especially in California, we're headed for a hard market, meaning rates are going to go up.
Okay, I was just going to ask. So, just to make it practical, if I'm a business owner, that's one of the ways that this shift is actually going to show up in my business over the next 6 to 12 months.
Yeah, if and I want to bore everybody with insurance jargon because I could go on with statistics, and you have to remember that insurance is kind of unregulated banking, and so the premium that you pay in as a client, as a company, goes just like the money you put in a bank, right? You put money in a bank, and then you make like so little, but they use your money to loan out to mortgages. So insurance is the same way. They use your premium to invest and make money. And so as a business owner, what you're going to feel because of a variety of things, not just insurance, it's also hurricanes, war, all kinds of things change what kind of money the carrier can make on your premium, other than underwriting profit. You're going to see rate increases. And so it doesn't matter how big you are. The Workers' Comp Rating Bureau creates a thing called a pure premium rate, a suggestion of what the carrier should charge for a particular comp code to be able to make sure they have enough, the carrier has enough to pay the claims. And the Work Comp Rating Bureau suggested an 11% increase in September of 25. And I think the unions and the Department of Insurance fought it and got it to I think the fact is the average rate increase suggestion in September 1st of 2025 was 8.7% increase across the board. So that meant Some work comp codes, the rate went down, some went up, but the average increase across the entire spectrum in California was 8.7%. That was in September of 25. That means anybody that renewed their insurance after September 1 of 25, the filed rate suggested by the Work Comp Rating Bureau went up. Now, maybe the carrier was able to give you a discount to kind of make that rate not go up much. But the overall trend is rates are going up for a variety of reasons. So your question was, how will a client feel it? They're going to feel, even if your losses didn't go up or down, if their losses stayed constant, your rates may go up just because the entire industry is feeling the squeeze.
I think that's one part that really confuses people, at least that I've experienced, the fact that your workers' comp rates are going to increase regardless of if you've had little or no claims. Can you go into that a little bit more?
Think of a think of it as the insurance carriers are taking a suggestion from the Workers' Comp Rating Bureau, the WCIRB. And what the WCIRB does for a specific comp code, like say you're a roofer that has, 4 or 5 codes. You got a clerical code, you got a sales code, you got a roofing under a certain hourly rate, you got a roofing over a certain hourly rate. The Workers' Comp Rating Bureau takes all the premium collected for that particular code for the entire state of California. So they know how much premium in total from all the roofers in California was collected on that particular code. And they also know what were the losses paid on that particular code. And so what they do based on that is they come up with a pure premium rate, which is the rate that you would have to charge everybody in that code to cover the losses for all the losses in that code against all the payroll in that code. And then the carriers come in and they put a rate together based on, okay, if the pure premium is $10, I need to have enough to pay commissions. I need to have enough to pay the overhead, like the claims department. I have to make a little profit. And they come in with a suggested filed rate, not pure premium rate, filed rate for that carrier. Like State Fund has their filed rates, Liberty has theirs, and on and on. And then they look at the individual client based on how much premium, what kind of loss ratio that particular client has, and they have latitude. Maybe they can go plus or minus 40% from their filed rate. But the basis, it would be like the cost of lumber for everybody went up 15%. But the guys that buy more lumber than the other guys will get a bigger discount. The guys that buy less lumber than the other guys might be not getting a discount. And so the basis for work comp is the pure premium. And whatever happens in that pure premium is an indication of where all the work comp codes are going in the state of California. And so when that happens, it's the very beginning of what we call a hardening of the market. And if you see that as a broker, then you can look at your client and say, we need to get ready for the market to be hardening so we can look at where can we place you that might make the pain created by the hardening of the market less painful for you. And it creates opportunities and also a detriment and a difficulty. If you don't have creative thinking about how do I address this, then your rates are just going to go up. And it has nothing to do with you. It has to do with the overall market. I hope that answered your question. It's a complicated situation, but if you hold in your head that insurance is just another financial transaction, kind of like banking. Whatever they do, they have to make money on what they're pulling in. And the overall market right now, I mean, look what's going on in the world. We have the price of oil, we've got war, we've got global warming, depending on who you are, whether you believe it or don't believe it. You've got a tremendous amount of things happening that drive the cost of insurance up that have nothing to do with the client themselves.
You've said this before, and I think it's really important. You've mentioned that a lot of business owners don't actually understand how their work comp is structured. And you mentioned just a minute ago leaning into the importance of having a broker who can kind of step you through the system. Can you break that down a little bit? The importance of a broker as opposed to going blind?
Yeah. So there are four ways, um, in a workers' comp world, there are four ways to insure it. There's lots of other little details, but there's basically four categories. One, there's a guaranteed cost. What that means is I pay, $10, $15 per hundred of payroll. I pay a premium, and that premium is a guaranteed cost. It's not going to go up or down for a year. You get a 1-year contract that, say I'm a roofer and I've got $1 million in payroll and I'm paying, $100,000 for workers' comp, and I'm paying, say, 120 to make the math easy. I'm paying 10,000 a month. Guaranteed cost, that's all you're paying. You got 1 year, that's all you're paying. If your payroll goes up, the amount you pay goes up. If your payroll goes down, the amount you pay goes down. It's all a function of your payroll, but the rate itself doesn't go up and down over a whole period of 12 months. And if somebody cuts their hand and it's a, $3,000 medical claim, that's covered. If somebody falls off the roof and becomes a paraplegic and it's a $5 million claim, that's all you're paying, that 120 grand. That's it. It's guaranteed cost. You're paying a premium to take the risk of whatever happens to your employees off your plate, and you're transferring that risk to the carrier, and the carrier will pay that claim. And so your cost is guaranteed. The second way is that you maybe decide, well, I'm so safe, I'm willing to take a deductible. It's kind of like when your car insurance, you want a $2,500 deductible, 5,000 at 10,000. Your car insurance goes down if you start taking a deductible. Work comp's the same way. You take a $25,000 per occurrence deductible and your comp rate's going to go down. So that's called a deductible policy. You have to understand over the last 3 or 4 or 5 years, if you had a deductible during that period, would it have cost you less or cost you more when you add the premium you're going to pay? So you have to do a calculation and understand that, maybe it sounds good that I take a $5,000 deductible per claim. Well, it depends. Do you have 50 claims a year, or do you have 1 or 2 claims a year? Certainly taking a deductible will drive the premium down. The carrier will charge you less, but you really got to do a calculation. You might pay more. So you have to be very careful about that. That's the second way. That's deductible programs. That's pretty simple. The third way is a way to self-insure. You either self-insure your entire work comp premium by having your own carrier, or a single captive or a group captive or a self-insurance program. When you do that, you're actually financing your losses. You're taking it away from the carrier. Like, say you're with State Fund, you decide, oh, I want to become self-insured. You have to go create like your own insurance company. The problem with that is that if you're not big, you have to do it in a group. If you're big and you have enough financial foundation, you can create your own. They're called captives, single captives or group captives. In a group captive, like say you're that roofer that's paying 120,000 a year, you would join a captive with a bunch of other roofers, and they would all be sharing the risk with you. Problem with that is that you have to put up a lot of money to get that set up. It's called collateral, because you're creating your own insurance company, and you're having what's called joint and several liability with all the guys in that group. So you may have no losses, and then you may have 2 or 3 guys in that group that have 5, 10, $20 million worth of losses. And so what could happen is that group could blow up, meaning they'd come to you and ask for more money, because it's not a guaranteed cost program. It's a program you have to finance yourself. They might come to you for more money downstream. And so in that captive market, it's a very popular thing for larger clients that have control of losses. But at the same time, you never know. Accidents happen. And if in a captive program, if you don't have enough collateral, instead of a deductible, you might have to put up, $2 or $3 million worth of collateral, meaning reserves, where if you had a $2 or $3 million claim, you have enough to cover it, because you also go to an insurance carrier, and the insurance carrier will allow you to use their name paper, but they're going to want a lot of collateral. And the problem with captives that I see is that if you don't absolutely have really good historical claims history, and have a lot of money to be able to self-insure, the first year is going to cost you more than it would with a guaranteed cost program. And that the second and third year, you might see a reduction because your loss is tracking good. It's a long-term financial vehicle for a large client like a Hewlett Packard or somebody big to actually pay in premium to the captive, have no losses, and now the underwriting profit that the carrier would normally get, you keep. But you got to be really careful. And so that would be the third way, single or group captive or self-insurance. The fourth way is there's a new thing going on right now where there are some of these, I call them bundled products, where you're getting access to somebody else's captive and they've already put up the collateral, they've already got the history, and they may be really good at managing claims and creating pay-as-you-go products. Pay-as-you-go, when you do your payroll, you're paying your comp, that you get access to their captive, but you don't have to put up a huge amount of capital. You don't have any joint and several liability, meaning anytime I say joint and several liability, what I mean is that the second or third year, they might come back after you for the first year for more premium because it blew up. Because the insurance is a 12-month contract. The minute you go to the second year, the premium you paid for the first year is used to pay whatever claims happened in that first year. But if you're 3 years downstream in a captive, and that first year that you already put all the premium in for blows up, meaning you have more claims than you have premium, they're going to come back after you for more money. And so these bundled products, they're already collateralized. They don't come after you for more money. They just look at you and say, hey, the public pool, envision, a public pool like State Fund, where they write everybody, has certain people in it that are really clean. I'm going to cherry pick those people and put them in my captive or my pool, this bundled product pool, and give them better rates, because the chances of them contaminating the entire pool is much lower than all the people that are in the state fund pool. And so that's something that is come out in the last 5 or 6 years, this bundled product access to a captive program where you don't have to put up collateral and there's no joint and several. And it's developing into a very interesting product. The brokers are not as familiar with that because it comes from kind of the employee leasing world or PEOs. That's for the broker, that's kind of like black art. It's like, what? How do you do that? But I've seen it for the last 8 or 10 years, and it's running really well. And so I have quite a few large clients that are interested in that bundled product. It's kind of like they get to put their toe into a captive program without the upfront capital, without the long-term possible liability. The rates aren't as good as your own captive in the beginning, but it's a much safer way to kind of figure out, hey, can I control my losses? And that's the fourth product. We have a lot of people interested in that product, brokers included. I have brokers that come to me and want to understand the product, and I'm very willing to explain it to them. I think it's a good product, especially if you're headed for a hard market. So if your broker is not structuring your comp and giving you the understanding of all four possibilities, then you got the wrong broker.
In your opinion, what makes a company a strong fit for these alternative structures you just listed out?
First of all, let's back up. The reason the prices are going up for work comp, when you look at what I said, the combined ratio, like all the work comp carriers as a whole, the cost is going up. It may not be borne by every single client, some really clean clients, but the reason the costs are going up, and it's pretty obvious if you guys think about it, you meaning clients, the cost of medical is insane. And so when somebody gets hurt on the job and they send them to the emergency, the first thing emergency says is that a work comp claim, because they know if it's a work comp claim, they're going to get paid right away. And the cost of all of those medical visits is going up, just like the cost of, as a consumer, the cost of medical insurance is going up. So when medical costs go up, when we're talking about medical severity, meaning if you broke your leg on the job 10 years ago and you went to emergency, it's pretty obvious if you went to emergency today, it's going to cost you more than it cost 10 years ago. Just the medical cost goes up because the cost of everything. The second thing is indemnity. Indemnity is Not medical. It's like, oh, I'm going to be off work for 3 months. The cost of what's it going to cost for that person to be paid is going to go up. The indemnity, because wages have gone up. The cost of living has gone up. So the indemnity claims go up. And then the third, which is really a driver, is litigation. You got signposts up and down the street saying, if you get hurt on the job, I can get you more money. The attorneys have gotten involved. And it's the facts are, you can go on Google and say, what is the cost of attorneys and work comp? It's pretty well known that somewhere between 25 and 35% increase in cost the minute an attorney is involved, because they get paid a tremendous amount just to do the investigation. And so all those things are driving up costs. So the answer to your question of what client fits the more creative work comp, it's clients that have control of their medical costs, control of the frequency, and have figured out a way to treat their employees in a way that the employee doesn't go looking for a way to get more money out of the work comp claim. So professionally run organizations that have good morale, that have employees that like working where they're, at the company, where I can see over the last 5 years that they don't have a lot of litigation in their claims, meaning the employees don't look for an attorney because they feel like they're being treated wrong, because that's really what will happen. That the medical claims, the frequency isn't high. They don't have like 50 claims. They just have one or two regular accidents instead of a terminally consistent problem with safety. So a lot of times you'll look at the losses and you'll see um, that a client with 50 employees has 30 claims a year. It's like, what the heck? What's going on? That's frequency. There's a problem if they have that. And so what I look for is a client that's been in business for a while. So they have history. Their employee morale is good. They have a fairly aggressive safety program. Their claims show that they don't have frequency problems, and that they have, maybe I have one client that they only had one claim in 2 years. They had a truck rollover. It's like that was a major claim. It was like a $400,000 or $500,000 claim. But if you look over the last 5 years, that's only one. They don't have frequency problem. And so there's ways to finance that. And so that's what I look for. Somebody that's got control of losses, they have good morale, their premium is significant enough cost to their product that it makes sense for them to either take a deductible or look at a bundled product or a captive product, because they have pretty good control of their losses. That's kind of what I look for. And another point is, one of the things I see is clients that are just looking for, I want the cheapest rate. I want the cheapest rate. I want to, let's shop to all the markets and give me the cheapest rate. There's nothing wrong with trying to find the most competitive rate. But you have to be careful, and brokers have a tendency to not advise the client. I can't say, and not all brokers, but some of the smaller, it's like, I'm just going to find you the cheapest rate. It's just like car insurance, homeowners, and just like any insurance, health insurance. The cheapest rate doesn't always equate to the best place for you to be, because sometimes these carriers will come into California and go, hey, I have no experience in California, so I don't have a lot of losses that are still developing from the last 2 or 3 years. I want to get into California fresh, and they come in with a very competitive rate. Department of Insurance looks at that and tries to help them not. They won't let them file rates that are ridiculous. The Department of Insurance actually looks at the rates and says, yeah, okay, I think you can do it. But some of these guys, they'll lower rates to get into the market. And then the next year, your rates go up because they just wanted to get market share. It's kind of like going to a used car dealer and you get the young salesman going, yeah, I got this car for $5,000, blah, blah, blah. And the next thing you know, that car, the wheels fall off of it on the way out of the parking lot. And then you come back and you have to buy another car. So I want to make sure that when I'm talking to the clients, that I create an opportunity for them to have relatively stable rates with someone that is not in for the quick fix and they're going to be gone next year and you're jumping around from carrier to carrier. That's not always the best way to structure work comp. After all, let's see if we can find the right product. You don't walk into the grocery store and buy the cheapest thing you can, because sometimes that's not a good deal.
Mhm. I feel like that perfectly exemplifies how the traditional approach of shopping for a better rate falls short. Curious if you could elaborate a little bit on your thoughts of the difference between buying insurance and structuring risk.
Yeah, the issue is especially for clients that what I call blue collar clients, which, by the way, the with the advent of AI, blue collar clients are going to have a renaissance because if you look at blue collar construction, anything that I would consider where you're not sitting in front of a computer, AI can't replace those jobs. And so those guys, home builders, people paving streets, tree trimmers, all that blue collar profession. Work comp is a very large percentage of their cost of doing business. Where like an accounting firm, their work comp is like 60 cents per hundred. But you look at a construction and their work comp is like $8 to $30 or $40 per hundred of payroll. So it's a very large percentage of their cost of doing business. And to just shop and get them the cheapest rate is dangerous because if you're a contractor, let's say that you're a building contractor and you're going to go out and contract to build homes, and your cost of doing business, a very large portion is insurance plus the cost of materials. Of course, labor is a big cost too, but the cost of materials, which includes insurance, is a pretty large cost. And let's say that your cost of doing insurance is on a 12-month contract. So let's say your renewal is in January of 26, and it comes up January of 27. And so what your cost is going to be for insurance for that 12 months of January of 26 to January 27. But you don't know what it's going to be January of 27. You're hoping it won't go up, but you don't know for sure. And in October of 26, you're entering into an agreement to build 20 homes, and your cost of building that home establishes what you're bidding to build that home in October of 26. So in January 26, you've already got your bid out. You've already been accepted. You're building the home. But in January of 27, the rates go up on your work comp. That just means your profit goes down. You can't go back and increase the cost. They're not going to do that. And so just having the cheapest rate is not necessarily the best way to go. What you really want, especially in the blue collar world, you want to know that your rates aren't going to go this way and that way. They're going to stay fairly constant so you can establish what you're going to bid on your jobs. And so what I do is I spend a lot of time trying to figure out how do I get my client stable rates over a longer period than a year. And some of these bundled products that I've run into, they understand that it's new. And so it's hard for people to I'm going to go from a guaranteed cost program into this other bundled product or a captive or whatever. What I've been able to do is show the client that the rates are more stabilized. And I've actually got some of these bundled providers to show a 2 or 3 year rate guarantee, based on certain criteria. But instead of going through a renewal every single year, it auto renews and the rate doesn't go up and down. And so what I've been able to show is that, that like say state funds rates go this way. Well, the bundle product rate goes this way instead of like this, because they're cherry picking the cleanest of the clean and putting it in their pool. And so what I've had is I've had clients, with a 95 to 98% retention, actually ask, hey, the rates went up 12% across the board. How come my rates didn't go up? Did they miss it? I go, no, because you're in a cleaner pool. And, maybe you have a $2,500 deductible in that pool. And so I hope that answered your question. But the structure, I'll give you an example. I have a client that wanted to be put in a bundled product, where they were getting access to a captive like rate with no upfront money. They were already in a bundled product and they heard that that was my specialty, that kind of bundled product. And what I found after I looked at it is that they were not getting the discount they thought they were getting. The claims weren't being handled properly. Their mod was going up. The bundled product provider didn't involve them in the claims process. So, there's some fraudulent claims that the the bundle product provider just paid, and I took them out of that and put them in state fund. And everybody I talked to, this is a client with $1 million and one in premium a year. Everybody I talked to said, oh man, state fund's going to be really expensive. It wasn't. They actually got more stabilized rates out of state fund because of the timing and some other issues. So what I try to do is give my clients the most stable cost structure for their insurance that I can.
It sounds like you're pretty keen on seeing the red flags that someone might be in the wrong structure. Do you have any other examples of things that might make a business owner pause and realize that they need to take a closer look?
Yeah, another one of my pet peeves is, so look at work comp insurance, and just let's specifically talk about work comp insurance. Really what you're doing is you're trying to transfer the risk to somebody else and pay a price for that. That's the premium. But the somebody else that you're transferring that risk to has to have aggressive claims handling. They investigate fraud. They have to work with you rather than just, hey, give me your premium. I'll take all the risk. And then you don't have to worry about it. You know, back in, I think it was in like 2000 to 2003, I think somewhere in that time frame, there was a bunch of carriers, work comp carriers in California that got into the market in California, very competitive compared to state fund. You know, their rates were 20, 30% cheaper. But I think it was 23 work comp carriers went bankrupt in California. And when that happens, you're used to paying $4, and all of a sudden you got to go to state fund to pay $6. And if that was a big piece of your cost, it's like you probably would have been better off paying $6 all the way along so that you adjusted your pricing to a stable cost, instead of going with a cheap carrier and then the carrier went out of business. And so clients don't know that until about 90 days before their anniversary date. They have this window 90 days before the anniversary date where they're running around. The broker's trying to go to all the markets, shopping all the markets. The broker doesn't want another broker to get in there and take the client. You know, it's this weird process where as a client, you really don't know until about 2 weeks before your anniversary date, because the carriers don't want to release your anniversary renewal rates until about 10 days or 3 weeks before your date, because they don't want you shopping to everybody else. So there's this whole, I have a term for it, but I can't say it publicly, cluster, you know what, happening 90 days before your anniversary date. I haven't succeeded in doing this with all my clients yet, but when I talk to a prospect and they go, oh, I've got my broker, he's shopping the markets, my anniversary date's June 1, we're already in April, May, June, I think I got it covered. If I have a problem, I'll let you know. They call me 2 weeks before their anniversary date and go, my rate went up 30%. Can you help? It's like, no, it's way too late. I can't help. What I do is I try to talk to the client 6 months before their anniversary date, even sometimes 30 days after their anniversary date. Give me 9 months to look at everything for you and try to give you the ability to understand everything way before this cluster, what happens 90 days before your anniversary date, because it's just a mess. It's terrible. And I haven't succeeded in getting everybody to actually do that because everybody's so busy running their business and they trust their brokers and they just want to tell me what my rates are. And I'm trying to proactively, and usually when I have a client, they go, well, what can you help me with? And I said, well, first of all, you got to be willing to learn more about insurance than you ever wanted to know. It's a very large percentage of your cost. And you really need to let me help you understand insurance the way I understand it, even better than I understand it. If you're willing to do that, then let's talk. And let's not talk 2 weeks before your anniversary date. Let's talk 6 months before your anniversary date. And then if you like what I say, then maybe you let me show you all the options before we get into that cluster, 90 days before your anniversary date. So you can go, oh, well, you know what, Steve, I like you, but I don't want to do any of those options. I'm going to stay with my broker. Great. Wonderful. I educated you. I made a friend. Or, Steve, I want you to go ahead and go out to all those markets and tell me what you got, and then I'll compare it to what my broker gets. Well, the broker's not going to get final rates until 2 or 3 weeks before your anniversary. So proactively look at the risk and the structure. You're actually trying to figure out how to structure your finances in your company, and insurance is a very big piece of that. And so that's kind of my approach.
Yeah, that whole scenario that you just explained really reminds me of one of the many reasons why insurance kind of gets a bad rap and is seen almost as this necessary evil. People don't want it, but they need it, and really highlights what I think that you bring to the table that's very different. A lot of clients aren't used to, which is the level of integrity and proactive education and working with the client.
To not look at the insurance piece and understand it is a real mistake. And it's like, I probably educate more prospects than I write insurance. And I'm okay with that. All I want is, oh, wow, I never knew that. Insurance can be a good transaction, a good financial transaction if you understand it. And you have to look at the structure of what is the best way to insure my business, not where's the cheapest rate. And so I spend a lot of time on that, way more than I should, actually. But, you know, I care, and I think people need to understand it.
Absolutely. I am looking forward to bringing our guest on for the second half of this conversation.
Yeah, and I'm looking forward to it too, because evidently a lot of people don't understand that. Because what I see with brokers, and I have a lot of broker contacts, they are pushing for the more sophisticated and larger clients to go into a captive program, which I don't disagree, but you got to be careful of a captive program. It takes an awful lot of money up front. You don't save money the first year, or you maybe save money the second, third year, depending on the losses. And this new product that I'm talking about, this bundled product, basically you're getting access to somebody else's captive, and they're giving you a discounted rate because they believe in you. And it'll be interesting to see how our guest is able to articulate what does that look like to the client. So it'll be interesting.
I agree. Awesome. Well, we're going to be bringing Ron Hodge from Cornerstone PEO on in a minute, and we'll be back with the second half. All right. We're joined by Ron Hodge, founder of Cornerstone PEO. Ron built Cornerstone from the ground up into one of the fastest growing PEOs in the country, leading the company through its early growth and some of the most challenging years in recent history. Ron, it's really great to have you with us.
Thank you very much. It's great to be with you guys.
I'm going to hand it over to Steve to lead the conversation from here.
Yeah, Ron, good to see you again. I mean, it's been 25 years or so. And what I really would like, we've created a podcast that explains the market in California is turning hard. The indications are that the work comp market is going to start turning hard. California is somewhere between 12 and 24 months ahead of the rest of the country usually. And because of that, we know as a broker that there's really only four ways that work comp can be written. One is a guaranteed cost program, another deductible program. Another is to try to create your own insurance company, like a single or group captive, which of course is very expensive and there's long-term risk associated with that. And then there's this bundled product that's been evolving since I started with it back in 1997. And you are one of those bundled products, Cornerstone PEO. But you're unique in that I've worked with 15 or 20 PEOs in the country, and you seem to have some flexibility. I've got a few clients with you, and I'd like you to kind of give us a little background of how Cornerstone got started, what your background is, and how it's changed over the years, and what your typical client looks like.
Well, thanks for that, Steve. The Cornerstone, I guess we started back in probably about 2012, 2013. I personally had been in the workers' compensation field for probably, gosh, it's got to be over 40 years. And probably close to 30 of us been with you, Steve. So we've kind of known each other for at least 25, 30 years, maybe. And been through a lot talking and especially about the industry. But I got involved in the PEO industry, which is a professional employer organization, as a result of forming a captive for a competing PEO that was out there years ago. And I found out how the secret sauce, so to speak, on how they were formed and how they were distributed, and decided that Cornerstone, that I could do it myself. Started the company out small with maybe it was myself and one other person and maybe $10 million in payroll and maybe 10 clients. And since then, I've brought on a lot of younger talent, a lot of 30 somethings and 20 something people. And the company has grown to, we think we could process maybe close to $1 billion in payroll this year. So from 10 million to $1 billion in 10 years is pretty good. It's pretty good. It's put us in the top 10% of the PEOs throughout the country. What makes us unique is that our relationship with our clients is from a client service representative to the end user directly. Our client representatives are people who can do everything required within the PEO industry, meaning they can process payroll, they can do onboarding, they can change class codes, they can do endorsements to the workers' compensation contract. So they are the focal point uh, of our service organization. Now, as we talked about before, see, there's uh, four four and a half different ways that you can buy workers' compensation. The first one is the way it's always been done for years, and it's been uh, time tested. It's a traditional, just a transfer of risk. I pay you a premium, you cover me for my workers' compensation claims. Then it evolved into different types of deductible programs where you, as the insured, will take on either a small amount or a moderate amount of risk and get a rate deduction for that, but you're also assuming some risk in that transaction. Additionally, as a result of all that, there's become what they call large alternative risk products, which are large deductible products that allow you to take a significant portion of risk and get what they call a deductible credit off of your rate. For instance, would be if you have a $10 workers' compensation rate, and that's per $100 of payroll, we'll say a carpenter, with under a large deductible product, if you had a $250,000 deductible, you would get approximately a 40% credit off of that $10 rate, or I'm sorry, a 60% credit off of that $10 rate, which would then make your rate $4, but you're also assuming the first $250,000 of that risk. So that's geared for individual insureds throughout the country who are who are large enough to take that and to manage that particular type of a risk. One of the additional, I guess, a spinoff of that alternative risk product is the captive industry, where you form your own insurance company, and that basically becomes it becomes a large deductible product with some tax advantages through domiciling and forming your own individual insurance company. So there's a whole myriad of different aspects. What we've done as a PEO is we've kind of taken all that together, and we can offer to our clients a guaranteed cost product, which means little to no deductible or claims fee or anything like that, maybe a couple $100, but it gives them, through the aggregation of all of our 4,000 clients and 55,000 employees, it gives them the ability to aggregate into our alternative risk product that we've developed, that's also backed up by our own captive. So we're giving the individual insured, somebody who is paying 100,000, 200,000, 300,000, 50,000, whatever that number is, we're giving them the ability to take advantage of some of the credit that we have under our large deductible product. Does that make any sense? Uh,
Absolutely.
it acts as a cost savings, and it creates a bundling effect uh, for all of our clients. So it's an aggregation of all of our work site employers, and I guess there's probably close to 4,000 of them now, and they're all in the same program, and they all take advantage of it. We use that same that same method with respect to employee benefits. We have great employee benefits products, and a two-man, a three-man, a five-man, five-person, I'm sorry, company can take advantage of the same benefit pricing that a larger company would also have. So it's basically the PEO becomes it becomes an attractive product for companies who are looking to take advantage of workers' compensation savings, benefit savings, uh, tax savings that we can give them, HR support that we can give them, time and attendance. There's there's a whole list of products that can be offered to the client. So if you don't have your own in-house HR facility, or you have an in-house HR facility that needs that needs a little bit of help, you come to somebody like a Cornerstone, and we take care of it all for you. So what we kind of try to tell our clients is that we take all of your non-revenue producing functions of your business, we take them off your plate, and we handle all that for you, and we let you do what you do best, which is, if you're a concrete guy, you lay concrete. If you're a carpenter, it's a carpenter. If you're a nursing home, it's a nursing home. We're completely heterogeneous. We have multiple class codes. I mean, hundreds of class codes that we accept and that we write. We do write, actually, we write in every state in the union, including Alaska, and we do have accounts in Hawaii. So we are truly, we're a national product. But what really I think makes us different, along with our client service people, was the ability for me to hire these 30 something kids who came into my business. I was chugging along, growing 10% a year, 15% the first couple of years. And it was like, okay, I'll get this up to, something reasonable and then retire. Well, the young guys came in. My payroll manager is a graduate of the University of Florida, and he loves the software products. So he's constantly tweaking with all of our clients their softwares. They can export their software into us. They don't have to actually change their payroll system if they don't want to. We offer that service for them, but we try to be flexible enough. We're not an ADP. We're not a Paychex. We're not you have to fit into their box. We're an organization where we'll mold the product around you. We will mold the product, make it exactly the way you want it, give you the client service representative who knows that product, because that person was involved from the beginning. So that person will know exactly what the nuances of your particular program are, and we go from there. So, like I said, I think we had talked years ago, Steve, and I told you that we like to call it a boutique operation, right? We sort of said we're a boutique PEO. We're not your standard big guy out there. We're just, we're here for the individual client, and we try to maintain that. And like we talked about this before, Steve, our client service to client ratio is at least half of what the industry is. So if you have a CSR who's got 200 clients, we cap out our CSRs. Each CSR is capped out at 50 clients. So that's all they get, but we pay them very well, and the clients know who they are. The clients can contact them 24/7, get a hold of them for any issues that happen. So, I mean, that's basically it in a nutshell. I mean, hopefully I've explained it.
One of the things that I've noticed, and we've had multiple guests and we'll have multiple podcasts trying to explain, what are the options for small to medium clients, not just for workers comp, but like you mentioned, getting all the non-revenue producing overhead off their desk. And what I've seen, and we represent quite a few of these clients along with all the standard markets too, as a retail broker. But what I've seen is that a lot of the PEOs, you have to fit their box. And the one thing I've noticed about your PEO, one of the reasons why I invited you in here on the podcast, is that unlike the others, not only are you aggressive and very progressive with your young people, kind of designing software around what the client needs are, you're much more flexible, and you're able to provide, a guaranteed cost program, a deductible program, a captive like program where the rates are maybe stabilized over a long period of time with no upfront capital. And the mechanics of it, we have a nurse staffing client with you that, the problem with the nurse staffing is they put a nurse on the site at a hospital and they're there 5 days. And then when they leave, they have to have a check. And so instead of having paychecks every 2 weeks or, twice a month or once a month, you're able to process to that client's needs. I think you told me they had 500 payroll cycles or something because of having so many employees all over the country, especially during that COVID crisis. So the specific thing that you have that is unique is the ability to be flexible to the client's needs. We even have clients that, they run their own payroll, like you said, in their own payroll system, because a lot of these more sophisticated clients, they have cost accounting tied to their payroll, and they can't just outsource payroll. They do their own payroll, and then they export the file to you so you can bill them for the comp and the admin and whatever other a la carte services they want. So that makes you unique in the marketplace. And I want people that are listening to this podcast to understand that the market is changing. And this bundled product, I call it a bundled product, which could be a PEO, an ASO, a staffing, a variety of things. This is something that most clients should look at, because to waste time shopping markets for comp and trying to do payroll and timesheets and time cards, especially in California, the client shouldn't be doing that. They should be focusing on their core competency of running their business and letting someone else handle all of those services. And one of the things that's really hard for business owners to understand is that that can be done less expensive than you're paying to do it right now when it's unbundled. And because of your flexibility of being able to design it around the client, I'm pretty impressed with the clients that I have with you and the clients that are looking at your product compared to some of the other PEOs. So, I really appreciate what you've said. And I think that as we do more podcasts, we'll bring more people in to discuss it further. Like, I'd like to bring in your benefits guy at some point and let him explain how does your benefit aggregation look better. But pretty much these bundled products like Cornerstone are giving small to medium clients, which is anywhere from 500 employees or even more, leverage, aggregate leverage, buying power. And I really appreciate your time, Ron. Is there anything else you want to bring up?
No, you're absolutely right. It really helps the small to medium to up. We say medium up to 500. We do have a couple accounts that are over, a couple thousand employees. I just want to emphasize that what we do is, and I will give you a for instance, we do the daily. We could pay people daily interim payrolls, and it happens all the time. Other people don't do it; they make you wait. But we don't do that. If your client needs the money, they get paid the same day. And just like in it, we have a great time and attendance software. But if your nurse staffing company has their own time and attendance software and they're used to it and they're comfortable with it, we just simply integrate ourselves with that. And it takes some mapping. They're called APIs, or
Right.
automated protocol interface. And that, so we're doing that on a consistent basis. But
Yeah.
it's worked out well for us. We have good clients. We have a great retention rate. We have testimonials. We can give references to whatever you need or any type of an account. I do wanna bring up can I bring up our state unemployment tax assessment? Do you know what, a SUTA rate is? I'm sure the clients will know what that is, but we go into to a state and we buy down a SUTA rate. And when we can buy down that SUTA rate, if you have a large landscaper in California, his state unemployment tax assessment could probably be upwards of 5.5%, right, on his payroll.
Yep.
What we do is we went into California and we brought down that rate, so now we can then offer that number to that the landscaper's not paying the 5.5%. We can give it to them for 2.5% because we've already brought that number down. So it's another cost saving source for your clients. So it becomes all together, it becomes all encompassing. So
Yeah, no, I agree. I agree. And then one of the things that's happening that we're trying to get out in this podcast is that we've been in California, we've been in a 10-year soft market, and that is not normal. There's all kinds of, and I don't have time to go into the detail, but there's all kinds of reasons for that. And that's over. We're headed for a hard market. And the clients that I've placed with you and other PEOs, once they get in a PEO, they never want to leave, because the value added services that you really don't have a complete understanding of what it saves you is why people stay. And so now that the pain is starting to happen in California and workers' comp, we want to get the word out to these small to medium clients, because I think they're the backbone of the economy. And I really I want to support that they ought to be looking at these products for their workers' comp and their benefits and their HR. So I appreciate your time, Ron. Selena, I appreciate that, you put this together. Is there anything else that we need to say, Selena?
No, if that's it from the two of you, I'll just wrap up here. As we wrap up today's conversation, I think the big takeaway is that the market is changing, but the bigger opportunity is how you respond to it. And that's exactly why we're doing this podcast, to help business owners cut through the noise, think more strategically about how things are structured, and stay focused on growing their business. There's more to come, so stay tuned. Gentlemen, I appreciate you taking the time to break this down.
thank
Thanks.
you.
Bye-bye.
Thank you, guys. Have a good day.
Absolutely. Thank you. You as well.